There is a building in London's Canary Wharf that has processed more money than most countries will ever see. Inside, for decades, thousands of people came to work every day. They wore lanyards. They carried coffee. They reconciled ledgers, vetted clients, monitored transactions, and filed the regulatory paperwork that kept the whole machine legal. They were the middle office, the backbone, the unsexy, essential machinery of global finance. In March 2026, the bank sent a memo. On March 19, 2026, HSBC Holdings, the sixth largest bank on the planet, confirmed what the financial industry had been whispering about for 3 years. CEO Georges Elhedery and his board were weighing cuts of up to 20,000 roles. 10% of the entire global workforce. Gone. Not the traders, not the deal makers, not the relationship bankers who take clients to dinner at Nobu. The axe was aimed specifically at what banks call non-client-facing positions. Their words: the compliance analysts, the KYC teams, the reconciliation specialists, the people who made sure the machine didn't break or break the law. HSBC's CFO Pam Kaur wasn't subtle about the reason. Speaking at a Morgan Stanley financial conference, she said AI would deliver cost efficiencies across customer service centers, KYC teams, and transaction monitoring. Bloomberg Intelligence took the cue and ran the numbers. 20,000 at HSBC is just the start. Industry-wide, up to 200,000 banking jobs in the same window, 3 to 5 years. This is not a rumor. This is not a think piece. This is a line item on a balance sheet. And it's just getting started. To understand what is actually happening, you need to stop thinking about robots on assembly lines. That was the first wave. The second wave doesn't look like anything. It lives in servers. It never sleeps. And it just ate your org chart. The technical term is agentic AI, not a chatbot, not an autocomplete, an autonomous system that runs complex, multi-step workflows end-to-end, triggering its own subtasks, checking its own outputs, escalating to a human only when something breaks the rules. One human supervisor, 20 to 30 AI agents, an entire operations floor in software. Let's be specific, because the euphemisms workflow optimization, operational excellence are doing a lot of heavy lifting. What is actually being automated is this: KYC and AML teams, know your customer, anti-money laundering, the army of analysts who spend their days verifying client identities, running risk scores, reviewing transaction flags, and filing suspicious activity reports. It is painstaking, document-heavy, legally critical work. Agentic AI now ingests the documents, runs the scoring models, monitors the transactions continuously, and files the reports at near zero marginal cost around the clock. What used to employ thousands of analysts in Manila, Mumbai, and Birmingham is now a software subscription. Post-trade reconciliation and settlement processing. Every trade executed on a financial market must be matched, confirmed, cleared, and settled. And when something doesn't match, it requires a human to investigate the exception. Goldman Sachs is already deploying Claude-powered AI agents for exactly these functions. The exceptions team, hundreds of professionals whose entire job was to catch and fix discrepancies, is being replaced by software that catches and fixes its own exceptions. Risk and compliance operations, collateral management, reference data maintenance, regulatory reporting. These are the roles that turned regulatory requirements into actual filed documents. AI now reads the regulation, generates the report, and routes it for signature. A process that took a 3-person team a full day now takes 11 minutes. And then there is JP Morgan Chase, which is executing the same playbook, just more quietly. In February 2026, Jamie Dimon publicly confirmed the bank has, in his words, displaced people from AI, and is rolling out what he calls huge redeployment plans, moving people into new roles, not firing them, not yet, but the net headcount math is the same. When your AI agent handles 30 functions a displaced employee used to handle, you don't need to hire 30 replacements. You hire one, maybe. The word that Wall Street is not using, because it would terrify too many people, is displacement without replacement. Now, if you are a shareholder, this script reads very differently. For the past decade, The single biggest drag on bank profitability was what finance executives call staff-related inflation. The relentless, compounding increase in compensation, benefits, training, compliance headcount mandated by regulators, and the sheer operational mass required to run a global bank. It ate margin. It limited buybacks. It was the friction the market couldn't fully price out. AI is the solution the CFO class has been waiting for since the 2008 crisis. And the numbers, compiled by the three most credible financial advisory firms on the planet, are extraordinary. Boston Consulting Group, in November 2025, projected that retail banks could unlock more than $370 billion in additional annual profits by 2030 through large-scale AI deployment. Their managing director framed it not as an efficiency play but as a complete business model transformation. The banks that move fastest will widen their competitive moat. The laggards will be acquired. McKinsey's Global Banking Annual Review for 2025 went further. In aggressive deployment scenarios, gross cost reductions in targeted functions, operations, compliance, risk could reach 70%. 70. And the mechanism is precisely the agentic architecture we described. One human supervising 20 to 30 AI agents running workflows simultaneously. Bank of America Global Research estimates that agentic AI spending will reach $155 billion by 2030, unlocking $1.9 trillion in value by handling just 10% of global knowledge worker workflows. Finance is explicitly on that list. The return on equity math is simple. Less labor cost, same revenue, higher margin, more capital return to shareholders. HSBC's targeted 5 to 6% reduction in annualized group expenses sounds modest. It is not. On a cost base running into the tens of billions, that figure represents billions in annual savings. Savings that don't evaporate. They compound. They feed buybacks. They fund dividends. They lift the share price. Every human role eliminated is a permanent reduction in operating leverage that the market will reward on the next earnings call, and the one after that indefinitely. The market is not being irrational. The market is being perfectly, ruthlessly rational. Now, let's talk about the other side of that trade. The roles being automated are not data entry clerk jobs. They are not minimum wage. They are not the gig economy. They are the jobs that built the global middle class. The compliance analyst in Birmingham with a pension and a 30-year mortgage. The KYC specialist in Bangalore supporting 2 households on 1 salary. The reconciliation team lead in New York paying off a student loan and saving for a down payment. These were white-collar, credential-carrying, upwardly mobile roles. These were jobs that, in the classic post-war contract, came with stability. You showed up, you did your work, you built skills, you got promoted. The bank was not your friend, but it was your employer. There was an implicit deal. That deal is now being renegotiated by a large language model running on cloud infrastructure at 1,000th the cost. The standard response from the industry, from Diamond's redeployment plans to every AI conference panel you've ever half-watched, is that new jobs will emerge. AI oversight roles, prompt engineers, data governance specialists. The economy adapts. It always has. Here is the problem with that argument. The AI oversight layer, one human managing 30 agents, requires elite technical skills, machine learning literacy, systems design thinking, regulatory fluency combined with engineering capability. The people who will fill those roles already exist. They are being recruited right now. There are not 20,000 of them available for every 20,000 displaced. The honest McKinsey math says AI could reduce net industry costs by 20%. It does not say 20% of those workers get retrained and redeployed. It says the savings go to shareholders, and that competition will eventually pass some to customers. Workers are the variable being optimized out of the equation. And here is the historical context that should arrest your attention. The last time capital reorganized the global labor market this completely and this quickly, it was called the Industrial Revolution. Handweavers, carriage makers, and artisans who had built stable lives on skilled labor were displaced in the span of a generation. Not individually, but as entire categories of employment that simply ceased to exist. The textbooks call it creative destruction. The people living through it called it catastrophe. The thing about creative destruction is that the creation part takes decades. The destruction is immediate. This is not an argument against AI. Technology is not a moral actor. HSBC is not a moral actor. Pamcor is not a villain. She is a CFO doing precisely what her fiduciary duty requires. El-Hedari is rationalizing a cost base the way every CEO of a publicly traded company is structurally required to do. The market incentives are perfectly aligned. The human consequences are not their problem to solve. The wealth transfer is the story. $370 billion in new annual bank profits by 2030. Almost $2 trillion in value unlocked by agentic AI. Capital that was previously distributed as salaries, benefits, and pension contributions will now be distributed as dividends and buybacks to institutional investors, sovereign wealth funds, and the upper decile of retail investors. If you hold bank equities in your portfolio, you will profit from the displacement of people whose jobs look a great deal like the jobs this industry used to help fund. That is the uncomfortable arithmetic sitting inside every HSBC bull thesis right now. March 2026 will be marked, in retrospect, as an inflection point. Not because HSBC cut 20,000 jobs. Companies cut jobs all the time. It will be marked because this was the moment white-collar automation moved from PowerPoint projection to balance sheet execution. From this could happen to this is happening. The people who will navigate this well are the ones who see it clearly, without panic but without complacency. The ones who understand that the question is no longer, will AI take white-collar jobs? The question is, how fast, at what scale, and who is positioned to survive it? Shareholders just got the most powerful margin expansion catalyst in the history of modern banking. The global middle class just got the memo. The clock is ticking for both of them, just in very different directions.